Holy smokes, everyone. This is an urgent, what the flippity flip flap flop, by crikey, breaking huge super duper news. We got ourselves a beauty of a video today. In this video, I'm going to be going over the latest prediction, the latest warning, the latest prophecy from Deutsche Bank, warning the global economy and especially the US is in right now a ticking time bomb. And what I think right now, we're in the lull, the calm before the storm. We're seeing the stock markets and the markets are flatlining. There's no more stimulus. There's no more money printing that's going on crazy like there was in 2020. Risk off assets like high growth tech stocks and cryptocurrencies are selling off. The bond markets are completely broken by the Federal Reserve intervening in the markets, so we can't see signals that we would normally see from the bond market warning us of what's about to come. And I'm not just going to be going over the article or the report put out by Deutsche Bank, but I'm also going to be going over the history, the charts, what led to the other crashes throughout history, what led to all those great crashes. We're facing them head on, and it is definitely going to come. We can't time when, but we are getting very, very close to one of the greatest crashes of all time, and the Federal Reserve is powerless to stop it. Okay, everyone, let's not waste any time. Let's get right into it. Okay, so looky here, everyone. Deutsche Bank warns of a global time bomb coming due to rising inflation. Now, I'm going to get into why rising inflation is such a risk, and you're not going to want to miss this one. So it says here, the effects could be devastating, particularly for the most vulnerable in society, the firm's economists said. Most on Wall Street and at the Fed see inflation as temporary. Like they always say, don't be alarmed, guys, don't worry, it's just temporary. That's famous last words they've said before every crisis. And they said it's temporary and the problem that will ebb as special factors fade away. We'll see about that. So the economist warns here, inflation may look like a problem that will go away, but is more likely to persist and lead to a crisis in years ahead, according to a warning from Deutsche Bank economist. And listen to this, everyone. In a forecast that is well outside the consensus from policymakers and Wall Street, Deutsche issued a dire warning that focusing on stimulus while dismissing inflation fears will prove to be a mistake, if not in the near term, then in 2023 and beyond. And I find this laughable. And when you listen to people, you have to go to their background and see what some of their motivations may be. So of course, Wall Street is going to tell you not to fear about inflation because they don't want people to pull money out of the stock market and out of their hedge funds. They're going to say, don't worry guys, keep putting money in, nothing to worry about here. Meanwhile, the hedge funds are shorting the markets, and the policymakers, aka the Federal Reserve, of course, they're going to tell people, never fear. They always say that. When have you ever heard the Federal Reserve say, guys, we should be worried, a crash is going to come? They'll never say it. The crash will literally be at the doorstep, and the Federal Reserve will keep telling people, don't panic. Like in 2020 March, when the whole financial system was collapsing, and they're coming out saying, guys, don't worry, America is strong, the economy is strong, everything's fine. When obviously it wasn't. They have to continually talk up the markets. That's their jobs. But back to the article. The analysis especially points the finger at the Federal Reserve and its new framework in which it will tolerate higher inflation for the sake of full and inclusive recovery. The firm contends that the Fed's intention not to tighten policy until inflation shows a substantial rise will have dire impacts. And guys, this is the new latest scam, the latest biggest lie the Federal Reserve is saying right now. And I don't know why people don't see it. I'm sure some of you do see it because our community here is very intelligent. We see the lies that the Fed is saying. They're now saying we don't just want full employment, or we don't just want unemployment of 4 or 3%. They're now using minorities as an excuse to keep the money printer going and to keep bailing out the financial system. What a complete lie. What they're doing is actually the complete opposite. They're making the minorities poorer by rising inflation because minorities spend the majority of their income on food, housing, and transportation, where the rich, food, housing, and transportation is a very small portion of their income. Most of their income goes towards investing. So how is the Federal Reserve expanding its balance sheet from 4 trillion to 8 trillion, devaluing the poor's money, making the cost of food for the poor skyrocket? How is that helping the minorities? Even if they do get a job, even if you get a job and you're making $15 an hour, but inflation is rampant, we face borderline hyperinflation and the poor can't afford to eat. In Venezuela, you had doctors that could barely afford food. So this is a complete lie, and it really annoys me. What they're doing is they're using the poorest excuse to keep bailing out the banks, to keep bailing out the stock market, to keep bailing out the financial system. Because you know why? They can't stop the money printer. As soon as they stop the money printer and lift interest rates, this whole financial system will collapse. This is not fear mongering. This is not FUD. This is simple facts, and this is a warning. But let's keep reading. I'm getting fired up today, guys. I don't know if you can tell. The Fed really grinds my gears. The consequence of the delay will be greater disruption of economic and financial activity that would otherwise be the case when the Fed does finally act. In turn, this could create a significant recession and set off a chain of financial distress around the world, particularly in emerging markets. So what they're saying here, everyone, and I completely agree, what they're doing is they're kicking the can down the road. Now, we all know that they've just been kicking the can down the road and people are like, oh, they'll just keep kicking it. But eventually the road will end. And now what do we have? They can't really increase debt anymore because the US government debt is maxed out. They've printed trillions and trillions of dollars. So during the next crisis, they'll have to print so much money that the dollar will completely die. People will completely lose faith in the currency because every recession, they print 10 times the amount of money to get the same result as the last recession. During the Great Recession, they bailed out about $700 billion into the financial system. This recession, they've done about $7 trillion. So during the next financial crisis, you're going to hear things like pumping $50 trillion into the financial markets. And by delaying it, by making the bubble bigger, when it does pop, it will just make the crash even worse and more painful than just getting it over with and doing it when the bubble's not as big, when there's not as much people exposed in the financial system, and when there's not as much leverage. Listen to this. As part of its approach to inflation, the Fed won't raise rates or curtail its assets purchase programs until it sees substantial further progress towards its inclusive goals. Multiple central banks officials have said they are not near those objectives. Well, what are we seeing? There's 9.3 million job openings, but obviously a lot of people, they may not want to go back to work. Now, not everyone, but a majority of people may not want to go back to work because they're making more money through unemployment benefits, and I don't blame them. Hey, if you're making more money, all for it. So once the unemployment benefits do end, I think we'll see a boom in jobs. So they kind of already reached their goals there, and inflation is more than double the Federal Reserve's mandate. So really, again, they're using this as a bluff because they don't want to stop the taper. They don't want to lift interest rates because as soon as they do, like I said, the whole financial system will crash. The stock market will crash. Cryptos will crash even more, and even precious metals will crash because when the dollar strengthens and interest rates go up, all assets priced in the dollar will fall, just like how assets have gone up because the dollar has been falling. And listen to this, everyone. This is what I agree with. The Deutsche Bank team disagrees, saying that the aggressive stimulus and fundamental economic changes will present inflation ahead that the Fed will be ill prepared to address. And you know an analogy I like to use? The Fed now is the arsonist and they're also the firefighter. They create the problem, they create the fire by letting inflation run hot. Then they're saying, okay, we know there's a fire here, but I think we'll just wait until it gets out of control. And then it gets out of control, and the Fed's like, "Don't worry, guys, I got this. I'll save you." And then they come to try to put out the fire, but it may be too late. The fire may get so out of control that they can't stop it, and then they'll have to come and bring more water and more firefighters to come try to put it out. aka they'll have to lift interest rates higher and higher to put the fire out of inflation. Listen to this, everyone. This is very important. All this suggests that Fed officials can stick with their plan to exit only very gradually from the easy current policy stance the people in Wall Street are saying. And what this economist is saying, and in a moment I'll get into all the charts and history of what happened with inflation and within interest rates and what led to a severe stock market crash in a moment, so don't go anywhere. He says that will be a mistake. Congress has approved more than $5 trillion in pandemic-related stimulus so far, and the Fed has nearly doubled its balance sheet through monthly asset purchases to just shy of $8 trillion. The stimulus continues to come through even with the economy that is expected to grow at about 10% pace in the second quarter and an employment picture that has added an average 478,000 jobs a month in 2020. So we've got a roaring hot economy, GDP's booming, inflation's booming, jobs are coming back, but they're still throwing more fuel on the fire. And Janet Yellen, she's saying, look, we're still going to keep spending money. We don't care if it causes inflation. We don't care if interest rates going up. She wants to spend like it's 1999. So what it's saying here is never before have we seen such a coordinated expansionary fiscal and monetary policy. This will continue as output moves above potential. This is why this time is different for inflation, because what he's saying here is normally it's just the Fed that's doing QE and really the government doesn't do anything. But now we got the Fed doing QE, interest rates at zero, the US government providing stimulus checks, providing unemployment benefits, and providing a lot of tax credits. So this is the perfect storm for us to lead into huge inflation, which is what's going to lead to the ticking time bomb. And we'll get into that in a moment. So the Deutsche team said the coming inflation could resemble the 1970s experience, a decade during which inflation averaged nearly 7% and was well into the double digits at various times. And we'll get into the history of the 1970s, because what I think is what we're doing now is heading into 1970 style inflation and stock market and macroeconomic picture. Soaring food and energy prices, along with the end of price controls, help push that era's soaring inflation. And people, this is a time bomb. This is a ticking time bomb that we're in right now. Look what they had to do to address this. The Fed chairman Paul Volcker led the efforts to squash inflation then, but needed to use dramatic interest rate hikes that triggered a recession. The Deutsche team worries that such a scenario could play out again. Already, many sources of rising prices are filtering through into the US economy. Even if they are transitory on paper, they may feed into expectations just as they did in 1970s, they said. The risk then is that even if they are only embedded for a few months, they may be difficult to contain, especially with stimulus so high. So this is the time bomb. And so the firm said that interest rate hikes could cause havoc in a debt-heavy world, with financial crises likely particular in emerging economies where growth won't be able to overcome the higher financing costs. So people, we are in a ticking time bomb. And all this means is if the Fed doesn't act now, instead of lifting interest rates 1 or 2%, and maybe we just get a small crash, in the stock market, in the housing market, if they let it get out of control and then they have to lift interest rates to say 4 or 5%, that's where we're going to see a full financial crisis and debt meltdown, because look at this. Let's get into the charts and the history. Okay, so one of the biggest lies the Federal Reserve is saying is M2 money supply increasing doesn't lead to inflation. Well, look at this chart, everyone. The black line is the M2 money supply and the red line is the inflation rate. And as we can see here, when the M2 money supply goes up, the black line, inflation follows. And when M2 money supply contracts, so does inflation. We can see here it's completely correlated. But Jerome Powell is now lying to your face. He's saying the increase of money supply no longer corresponds with inflation. Look here in 2020. Or 2018, they started increasing the money supply in 2019, and that's where the financial crisis really started with the repo markets. And as we can see here, when they started doing that in 2019, we can see here the red line, inflation started to increase, and we're now at 4.1% inflation. So of course it is correlated. And why this is a big problem, because look at the debt. The debt is increasing, so this is also going to lead to higher inflation. Just over the past few years, the debt has gone from around 19 trillion to 28 trillion. And what's going to happen to the US government if interest rate spikes? Are they even going to be able to afford to repay just the interest? And of course, we've got borderline hyperinflation in the commodities. We've got gasoline up 57%, ethanol 71%. We've got corn 40%, canola 37%. We've got coffee 24%, sugar 14%, lean hogs up 71%, beef up 11%, poultry 17%. We've got all the industrial metals, lithium 91%, tin 53%. So commodities are rising, and that's going to lead into high consumer prices. But let's now have a quick look back in time, because the best way to predict the future is to learn from history. what happened in the 70s to the financial markets with high inflation? Well, if we look here in the charts, I'll just make it bigger for you. In 1970, the inflation rate was around 5.6%. But then in 1973 and 1974, inflation got out of control to 12.3%, and the Federal Reserve had to lift interest rates from 5% to 9%. And then also look what they did again in the 80s when inflation got back up to 12.5%. They had to lift interest rates to 18%. Can you imagine what would happen to the financial markets if interest rates just went up 5%? Because we can see here from 1976, I'll just bring up the chart here again, interest rates went from 4.75% to 18%. So it increased. So that's a 14% increase in the federal funds rate. But you know what? It's not going to take interest rates to go back up to 10, 15, 18% for us to see a huge financial crisis. All it's going to take, because leverage is so high, is for interest rates to go up to, say, 3 or 4%, maybe even 5%. If that happens, we're going to see one of the biggest crashes in our lifetimes because there's so much leverage in the system. Like I've shown you with the charts, margin debt is at all-time highs. We've got people paying crazy amounts for homes. And even if your mortgage is fixed for 30 years, well, your house is only worth what others are willing to pay. So if other people start selling their houses in your street and, interest rates or mortgage rates go up to 7, 8%, then that means people are going to have about 30 or 40% less purchasing power. And so when you go to get an appraisal on your home, the valuer is going to look at comparable sales in your street and they'll see it's much less. So then that's going to affect your home's value. And let's have a look at the S&P 500 returns to see what happened last time we had crazy high inflation and when the Federal Reserve had to spike interest rates. So if we look here at 1973 and 1974, it dropped 14% in 73 and 26% in 74. So we saw about a 40% retraction in the S&P 500. But now there's a lot more leverage in the system, so we could see an even greater, say a 45 or 50% crash. So everyone, just to put it in simple terms and bring it home, just because we haven't seen a big crash over the past 13 years, remember, we've been in a 12, 13 year bull run, which is not normal. Yeah, we did have a crash last year, but that wasn't a sustained crash. It went straight back up. So I don't really count that as a bear market because we had a V-shaped recovery in the stock market. And also the US is due to lose its world reserve currency status because the US hasn't always had the world reserve currency status. Before that, it was the British Empire. And, Spain, Netherlands, they've also had world reserve currency status. And normally empires or people that have had world reserve currency status over the past 500 to 600 years normally only last 80 to 110 years. So that also means the US is due to lose its world reserve currency status. And when that happens, it's going to default on the debt because people won't want to keep lending to the US. And then that's when things are going to get really ugly. Now, I just want to reiterate, I don't know exactly when this is going to happen. I'm not predicting this is going to happen next week, next month, next quarter. Nobody knows. But what we can get is a rough idea of where we're at in the cycle. And I think we are very close to the peak. There's so much risk that people are getting so complacent they think the stock market can never go down. Well, we've just had a very short period of time. People looking very short term. When you go back through history, big, huge crashes are quite common. And the biggest thing I'm worried about is the Federal Reserve's not going to act on inflation. They're going to turn a blind eye to inflation because they don't want to crash the stock market. They don't want to crash the housing market, the financial system. So they're going to let it run hot. They're going to keep printing money. But then that's just going to make the financial crisis in the future even worse. So everyone, what can we do to prepare then for this crash? Well, what this means is you want to be in risk-off assets. Like, for example, even though it may seem crazy, being in the dollar or holding cash, if interest rates do go up, the dollar will strengthen and stocks will fall. So even though you're not getting any interest, if instead of having your money in stocks and the stock market falls 20% and you don't get any interest on your cash, but your cash holds its value, if interest rates go up, well, then you've made an effective 20% return. Now, I'm not saying go all in on cash, but I'm saying you're going to want to have some cash on the sidelines. So if the markets do crash, when there is blood in the streets, you can go up there and buy everything for pennies on the dollar. Now, as long as the dollar doesn't get too high, and if we do see, a full fear in the markets and uncertainty, precious metals may be a good safe bet. But if the dollar goes sky high and interest rates go sky high, normally precious metals perform badly. Precious metals typically perform well when interest rates are low and inflation is high. So we may see short-term precious metals go up, but once interest rates do start going up, and if the dollar does strengthen, precious metals won't be safe either. Now, normally during recession times, if you're into stocks, value stocks, so stocks that have low PE ratios like grocery malls, and if interest rates do go up, normally banks perform better because when interest rates go up, banks' margins get bigger. So that may be a good play as well. And also dividend stocks tend to perform well during high uncertainty times, because even if you're not getting any returns in the stock market, if people are still getting a 4 or 5% dividend, they'll keep piling into those stocks. So they may be affected less as well. But again, this is not financial advice. I'm not telling you to do this. This is just some of my thoughts and opinions from studying history, from studying how markets work and how markets normally work during downturn and during high turmoil periods. So everyone, I know this was a crazy video. It sounds pretty grim. It sounds pretty doom and gloom. But unfortunately, this is honestly, with my hand on my heart, what I think is going to come. I'm not doing this to spread fear, for clickbait. Honestly want to warn people, have people prepare. And again, also what you may want to do, you may want to, grow your own garden, have your own self-sufficient energy source, become more self-reliant instead of relying on the grid. That may be the best investment really at the end of the day, and all sorts of fun hobby. But again, this is just a warning. This is just something to take into account. Go and do your own research and make up your own mind on what you think will be happening in the future. Now, for all my loyal viewers and subscribers still watching, you're awesome. If you haven't already, please tap that like and subscribe button. I'll keep you updated on the latest happening in the stock market, the economy, housing market, and global finance news. If you're bored, I'll put up some other videos here. I'll see you all there.